Hi there, Evan here at the Chronicle for Sunday, January 6th, 2020, where that future starts today. And again, I wish all of you a very happy new year. With all the news happening in Iran and Iraq right now, which again, I won't cover in this video, geopolitics isn't an area of expertise for myself. There is some news that happened within the markets and the economy that carries a lot of importance with it also. In today's video, we're going to cover some of it. Now for our first story of the day, this broke on Zero Hedge Friday afternoon. Here comes the liquidity drain. FOMC expect the transition away from active repo ops starting in the middle of January. Now in my predictions for 2020, what was prediction number one? Prediction number one was that the Fed was going to end this round of QE infinity in Q1, lead to a market correction, which then forces the Fed back in, one last blow off top, and then end of Q3, Q4, as fundamentals within the economy and earnings start taking over, we were then going to have a bear market. So if this happens, the chances of prediction number one coming true went up by a lot. Now with hedge funds, we can't forget they were one of the factors in the repo madness at the end of the third quarter in 2019. As money was coming out of hedge funds throughout all of 2019 to keep the returns up, to gain leverage on their books, they had money coming in via the repo market to go ahead and compensate for this. And that's, as a Coles Notes version, that's what was going on there. So hedge funds were one factor. Factor number two, the massive US government deficits and the massive amount of newly printed debt that were induced by the tax cuts in 2018. At that time, all the new debt that was printed, the primary dealers had to come in and soak up all the excesses. And at the end of the third quarter in 2019, convenient timing of the repo madness, the primary dealers simply couldn't soak up any more of the debt that was being printed, particularly in treasury bills, which then led the Fed in to come in and buy the excesses the primary dealers couldn't take on, which led to the QE that wasn't QE. While we're on that topic, by the way, Barton Options has a great Twitter thread about the FOMC minutes that he put out on Friday night. I will leave that link in the description. And what the argument is that the backlog of treasury bills is going to transition to 1 and 2 year treasury bonds starting in the middle of March. Conveniently enough, I do have, on the next market correction, the Fed coming in with more liquidity. How conveniently timed, in the middle of March, they have to come in and soak up more 1 and 2 year treasury bonds the primary dealers can't. So there you go. That's factor number two. And then factor number three, again, all speculation on my part, China and Hong Kong. So the moral of the story here, again, that Twitter thread from Barton Options I'll leave in the description. My video about my predictions for 2020, I'll leave in the description also, because it looks like it's going to play out exactly in that direction. Enough of that. And now for our second story of the day. The US ISM manufacturing report has broken below the early 2016 low, and most importantly, broke through the late 2018 low that everyone thought was going to be the bottom for the downturn because of the phase one trade deal that was apparently signed between the US and China, which I've always said is a sideshow. But anyways, it is at the lowest level since 2009. And within it, employment is now at its lowest level since 2016. And jobless claims in the US on a year-over-year basis have been up for 20 straight weeks. As I always say on this channel, manufacturing is downstream from the consumer. Hence, it's a great leading indicator of what's going to happen in the economy for the next year or so. And also retail sales have been very soft since the third quarter of 2018 in the US. In Canada, it since the third quarter of 2017, but I digress. What I'm saying here is the forward-looking indicators, the present-looking indicators, all tell me that the next 18 months, at the very least, don't look good for the US economy and don't look good for the global economy. Again, as I mentioned in a previous video, you may see a brief stabilization Q1 into the beginning of Q2, but then everything falls off a cliff after that. And as I've been mentioning many times here on this channel, it looks like we're headed for a global recession at the end of 2020. Enough of that. And for our last story of the day, in Toronto, Airbnb hosts will now need to register with the city starting in the spring. My two big issues here: one, enforcement. It hasn't been very good in Vancouver. I can't see it being very good in Toronto. And secondly, if you were really spooked by this and were a condo investor and your condo's up in value since you bought it, my best advice, if you're really spooked, go ahead and sell, wash your hands of it. Again, full articles in the description. That's my 2 cents. Anyhow, best place to go ahead and leave it. Smash that like button, leave a comment, subscribe, follow both my Twitter accounts. And as always, my name is Evan. This is the My Chronicle, where that future starts today.